we're not trying to say term is bad, but when you adopt the philosophy of buy term and invest the difference, we're positing that there's a better way of that.
Our money and our policy is growing and compounding. At the same time, we're paying a simple interest on a depreciating loan each month and each year.
It's frankly the safest place to put your money. It's the foundation to build and grow from. Start thinking about where you're putting your money and why are you putting it there? And is it the best strategy?
Hey, what's up, everyone? Welcome to Wealth Webinar Wednesdays. My name is Stephen Nagy. I'll be helping host the show today on behalf of Chris Naugle, along with Mr. Craig Yenny and Shauna Decker. We have a really cool show planned for you today. We're going to get into the infinite banking concept, what it means to take back control of your money, and how we can use this to solve your money problem. We're going to demystify some parts of infinite banking today. We're going to try and break the old saying of buy term and invest the difference. We're going to break that down and why that might not make the most sense. And we're going to show you maybe a better way here today. So with that being said, I'm going to turn this over to Craig Yenny for a moment. And if you guys don't know Craig, you're in for a treat, because Craig is one of those guys that does something, learns every little piece of it, know everything about it, and then he's out there and he's sharing it with others and doing some cool things. And we call Craig the freak in the sheets because he loves those spreadsheets, and he can take what Chris and I talk about all the time. He can show it in mathematics and through these spreadsheets. It's fascinating to me. I'm just not that good with this stuff. So that said, Craig, what's up, man? I'm looking forward to today. It's gonna be a lot of fun.
Hey, good to see you, Stephen, Shauna. I'll tell you what, there's a spreadsheet for everything in life. I mean, I can use it to track my workouts. I can use it to track my finances. I mean, what can't you use a spreadsheet for? I mean, they're the best things out there. But anyway, what we're going to talk about today, and I'm just kind of curious for the folks out in our community, the first thing I want to know is who's here for the first time. I always love to know who's here joining us for the very first time. And if you are, say I. I know last week we had a lot of new folks. Well, welcome aboard.
Welcome, everyone.
Yeah, this is awesome. So we're going to be covering some pretty meaty things today. And we're going to, at the end of the discussion today, we'll give you some resources that you can dig into. But we're going to be talking about the old buy term, invest the difference. But before we jump into that, I have a couple things I want to share. Who here, while we're waiting for all the new people to come forth and show who they are, there's a lot of them today. Who here has heard of the buy term, invest the difference strategy? Are you guys familiar with that? Shauna, you know about it. Yeah. So some people have, some people haven't. So we'll spend a little time talking about what that is before we get into, really what it's all about. All right, awesome. Before we get started, I do have a confession to make. Shauna, Stephen, I really feel I just have to make this confession so everyone knows. We do these wealth webinars. We do Ask Me Anything every week, WTF, all these shows. And we're doing education on the infinite banking process, but we have people that'll comment on different things in our social media. And how many times have we heard, well, that's a scam? How many times have we heard, you guys are just trying to sell whole life insurance policies? And so I have this confession. I'm just going to lay it on the table. How many people do we have for today? 178 so far joining us. Guess what? I want all 178 people that are on this call today to have a specially designed and engineered whole life policy from a mutual insurance company. I'm just going to put it out there. I want you all to have one, right? Shauna, do you want everyone to have one?
I do.
Let's not hide behind the fact. And a lot of folks here probably already have one. But here's why I say that. We do this teaching, but at the same time, the reason we want people to have this tool in their financial life is that it provides safety, it provides guarantees, it provides you a way to take control and be in control of your money. And Stephen, how many times do we talk about what we do is teaching people how to take control of their money?
That's it, man. That's what it's all about. It's solving a problem. It's not the policy. It's not the product. It's the process of infinite banking and what it can do in our lives for our families.
Yep, absolutely. So what I want to do is take you on a tour back in time, because I was thinking about this whole buy term invested difference. I thought, my journey to infinite banking will kind of help a lot of people. And maybe you're like me. Maybe you are in this situation now, or maybe you were in these shoes. But I'm gonna rewind, and it just makes me feel so old thinking about this. But we're going back to 1992. I know some of you on here are probably like 1992. I wasn't even born in 1992, but what was happening in 1992 for me is I was just getting out of college. So I went to college, spent 3 years just going all year round because I wanted to get in, get out. And so I came out of college with an electronics engineering degree, got into some job working for the Department of Defense, building missile defense systems. It was so cool. It was so fun. But when you start a job, one of the things they tell you is that, hey, we've got this thing called a 401k. And I thought, well, isn't that cool? I can go and focus on my job and my career, and I can put money into this 401k system, and they're going to take care of me, right? I'm just going to pile this money in there, and someday I'll have this money built up for retirement. All right. So you get in the pattern. I'm sure if anyone on this call is like that, just like me too, or something like that, I just want to know, did anybody else start out in life and just think, well, these 401ks, the TSPs, whatever they are, we're just going to put our money in there because someday we'll be taken care of. So let's kind of fast forward 15 years, and I cannot believe 15 years went by. But through that journey, I kept on seeing more and more money go in the 401k, and I kept seeing my balance go up and down, up and down, up and down. And then 2007 comes around. Who remembers the 2007, 2008? What happened around that time frame? We had some market corrections, right? Yeah. So we had the subprime mortgage things, or market crashes. And at that time, I'm just going to tell you, I had a lot going on in life. And maybe if you ever meet me in person, we can sit down and talk about it. But there was a lot of crap going on in life, and I knew what I just spent the last 15 years doing just got blown up in terms of the accounts, the financial crisis. And I thought, what am I going to do? Because this isn't going to work. And let me ask you, do you think Wall Street, the mutual fund managers, the government who you're partnering in your 401ks and your ESPs, do you think they care more about your money than you do? Does anybody out there think they care more about your money than you do? I don't think so. So I came to this conclusion, what I was doing wasn't working. And I don't know if there's anyone out there. Have you ever been in a situation where, like, I know what I'm doing is not what I want to do, or it's not working, but I don't know what to do next? That being in that place kind of sucks, because you don't know. It's like, where do I put my money? How do I invest? And I started reading books, and I read Robert Kiyosaki's Rich Dad, Poor Dad. I love the book. But you know what I walked away with that with? It was like, okay, this is great, but how do you do it? How do you do it? And I'm sure a lot of people hear infinite banking. Well, how do you do it? And that's why we're here teaching all the time. So anyway, fast forward, I met a guy at a seminar, and guess what? Back in 2007, 2008, we didn't have the YouTubes. We didn't have Steven and Chris out there talking about this stuff. We didn't have the YouTube channels, the Instagram. So I went to a live event, and there's this guy up there talking about how you can pay for college for your kids with your own system, your own banking system. Like, what is this guy talking about? So after the seminar, I went up to him like, how do I learn more about this? And he said, well, you can book a call with me, or you can read a stack of books this tall. Does anyone guess what I said? Can anyone guess what I said? Well, I didn't book the call with him. I said, I want the books. And so some of the books, Stephen, Sean, I don't know if you guys have read these too, but Barry Dyke wrote The Pirates of Manhattan. And I started learning more about how Wall Street, the stock market worked, the creatures of Jekyll Island, how the Federal Reserve started, what that's all about. And so I just started getting really educated and getting more and more frustrated, because I knew that what I was doing wasn't working, but I still didn't know what that answer was. One of the books in the pile was the Becoming Your Own Banker by R. Nelson Nash. And that started the journey. It took me a year to finally pull the plug, get my first policy, stop funding 401k, putting everything into the policy. And I still didn't know what this whole thing was about, but it, just like all of you, you start and then you learn, you grow, you do more. So you might start with paying down debts. You might start with financing major purchases. Eventually you might get into doing investments. But anyway, that's kind of how I got from where I was many, many years ago to this. And then when I hit about age 52 is when I retired from that whole high-tech career and just decided to go do this full-time and teach it. And so that's why, fortunately, I found, you guys, Chris and Shauna and Steven, found you guys. I'm like, this is where I belong. And so we've been working together for the past 2 to 3 years. I love it. It's great. We're just going to keep going. And anyway, that's the story of how I started getting into infinite banking. But in that whole journey, I was always told buy term, invest the difference. And I did that for a while. I bought term. I put money into mutual funds. I had a stockbroker, and this guy would teach me to do, and it was really cool for a little while until it didn't work. But I would buy stocks, and then he'd say, "Oh, all of the money that you have in your stock account, you can margin that and buy more stocks." I'm like, "Oh, that's really cool. How do we do that?" And so I started margining my accounts and buying more stocks. And guess what? When the stocks went down and they did what's called a margin call, I didn't have the money. So guess what I had to do? I had to sell my stocks to pay them off. Now, who made the money in in all those transactions? Because it wasn't me. It was that stockbroker. He made all the money. I didn't make any of the money. So anyway, that's kind of the journey that I've been on and why I'm so passionate of why I started with this, the confession of I want everyone on this call. What are we up to? 212 people. I want all 212 people to have a specially designed and engineered whole life policy from a mutual company because it's frankly the safest place to put your money. It's the foundation to build and grow from. And that's what Sean has done. That's what Steven's done. That's what Chris has done. That's what all the people on our team have done. So that's why we're here to teach it. So anyway, I'm gonna step off my soapbox. We have any questions out there? But anyway, I just want to share a little bit about that history of why I'm so passionate about getting people into this type of a program versus what I was doing.
I love it. And Craig, you have a policy. What I love about you is my policy, I think my oldest one is maybe going on its 6th year, but you're on your 16th year. So I also love knowing somebody like you who's got all that time in and couldn't be more happy and wish that they had more of those 16 plus year policies, right?
Absolutely. I mean, it's just a great tool. I mean, it's now at the point where it's way beyond its efficiency, and I get way more money out than I put into it, and it just keeps growing and growing and growing. And, if I hear people talking about, oh man, my 401k went down X, whatever that number is, 20,000, 30,000, 40,000. And my policy just keeps going up. My policies, I should say, just keep going up every day. Now, what am I doing with that is, this is where, Steve and Shauna, we talk about Private Money Club a lot. That's a lot of what I do with my policies, but this has just been the foundation. And it wasn't a get rich quick scheme. It wasn't that I was able to turn the corner in a year or 2 years or 3 years, but over that 10 to 15 year time, I built up a pretty good system. And so that's really what we're here to teach is if you've got that long-term perspective and you want to build wealth and have control of your money, that's what this is all about.
Yeah, and right before we get started too, Gerald put in the chat, could you suggest some mutual fund insurance companies? And I just kind of want to put it out there that we do teach this, but a lot of us on the team, not me, but our team is licensed in all 50 states and can actually help you get one of these policies that you're going to learn about today. And we work with, I think, 4 or 5 different companies. It depends on where you're located in the US and kind of like your needs and goals. So I just wanted to put that out there too, that if you do like what you hear and you want to get started, we're the ones that you would want to get started with.
Yeah, absolutely. And what I was thinking, we want to just have a dynamic conversation today. I mean, I've got some resources we'll share out at the end. If someone wants to read a very detailed document on buy term, invest the difference, we'll get that in your hands. But one of the things I really, really, really want to stress out of this, when we're talking about buy term, invest the difference, we don't want to plant the seed that all term insurance is bad, because what does term insurance do for you? Stephen, what can people use term insurance for? Or Shauna, what can people use term insurance for?
Well, nothing. They can't use it for anything except for in the event that they pass within that frame of time, correct?
Right. So it can provide an income protection while you're, say you've got a young family, you don't have enough death benefit protection inside your whole life policy. And so it can serve that purpose where you have that income protection, God forbid something happens to you or a spouse. And so it's one of those things where, we're not trying to say term is bad, but when you adopt the philosophy of buy term and invest the difference, we're positing that there's a better way of that.
Yeah, there's a lot of uses for term insurance. I mean, we use it all the time. So in real estate, for example, let's say you have 10 rental properties and those are leveraged with mortgages and just in case something happens to you, you don't want all that debt to stay on the books, but you want those assets to pass down to your family. So one of the best ways to do that is to protect that debt with a term policy that pays all that debt off, if you were to pass. Another way we use it is in our businesses. So when we create a business, on the key executives, the owners of the business, oftentimes, especially if they're an integral part of the business, where without them, the business could fail, or maybe, the equity of that business passes to the spouse or the family, in the case of a passing, but the family doesn't want that equity. The family just wants to be cashed out. So we'll get a term policy to cover whatever that amount is to buy out that family to keep the business going and allow it that way. Like you said, Craig, younger, families, maybe
Yep.
they don't have the funds for a whole life policy, but they want to protect it just in case, knowing they're going to do better later on, especially I know we can talk a little bit about like convertible term policies and guaranteed approval, convertible term and things like that. So there's a lot of uses. I mean, we use term insurance every single day in what we do with infinite banking to work within the government regulations, what's called MEC. And the way we do that is by adding term insurance to allow us to have huge cash value, become the bank, and put big dump-ins in these policies, and be able to use a little bit of term to avoid, the legal ramifications. So there's lots of uses for term for sure.
Yep. Yep. So what we're talking about today with the buy term invest the difference, we're not trying to put term in a bad light, but when you adopt the philosophy that a lot of folks out there teach, which is just buy enough term insurance to cover your death benefit needs and then go put the rest into your investments because whole life is garbage. What we're trying to tell you is there's a different route you can take on that. So Stephen, just a couple thoughts. I mean, we can jump into some of the content. We do have a fair amount of new people. Do you think it would be worthwhile just to go over a quick introduction of what is infinite banking? How does it work? What is the purpose of it? And then we can kind of transition back into some of the buy term invest the difference and talk more about why we don't think that's the best strategy.
Yeah, absolutely. Let's get into it. We had a lot of new people on, right?
Yeah, so there were a lot of new folks that said, first time coming in. So, for everyone on the wealth webinar today, I mean, it's almost sometimes like a kindergarten class where, we've got people that have been here with us every show, and they're like, you guys are a little repetitive on some of the stuff, but we're always trying to make sure for the new folks, we give you enough content to help understand what is infinite banking and then get into some of the meatier topics. But
Yeah,
yeah, if you could
there's
just
different.
give maybe an example.
Yeah, start kind of with the basic, Craig, just so everybody understands it. Even if you have a policy, it's good to kind of, remember some of this stuff because you hear a lot of terms. There's a lot of noise out there in the world right now. You see a lot of these influencers on social media that push certain insurance products, trying to, say you can use it for infinite banking, or maybe it's infinite banking 2.0 or infinite banking 3.0, or, they try to really dress this stuff up. And at the end of the day, it's really not that. So we want to kind of get back to, okay, what is some of this stuff? So if we look at, for example, when it comes, well, first off, when we do the infinite banking concept, we do it for a few different reasons to become the bank. So we want to have control of our money. So let's just lay out, Craig. And if you have a policy or you've been watching this, lay out some reasons, why you started a infinite banking policy, why you're doing this. Just give me some reasons and I'll kind of list them out. So write why on here. For one, I would say control. Give me some reasons of why you're putting money into a life.
Christian just put in to pay off debt.
Okay.
To use
Shane's,
it.
yeah.
I'm going to say to use it.
And what do you, so Shauna, I mean, you have a pretty unique case. What do you put yours every year?
Yeah, so I started a very small policy in the first few years with the goal to, 5 years down the road, be able to lend it, which is where I'm at right now. But in the beginning, there wasn't all that much cash value, maybe like $3,000. And at first, it was actually Andrew who on our team who gave me the idea, because at first I was just treating it like a glorified savings account, and I was like, oh, I don't know what to do with it. And he's like, well, you go to Disneyland every year, just use that to go to use your cash value to go to Disneyland. So once it clicked for me and it stopped being that glorified savings account, even with this lower cash value, I've used it for trips. I've used it to buy a go-kart. I've used it for all sorts of fun stuff. And now I use it for private lending and investments.
Nice. And Stephen, you got a little
What are
blurry.
some technical reasons on here real fast, Craig? Like, what are some more technical reasons? So why put money into a policy?
Well, you can, I mean,
Protected,
legacy
right?
is,
Protected.
yeah, legacy is one of the things that came to mind too, but protection, tax benefits,
Tax.
or tax favored, maybe.
Legacy. So let's just talk through it. So control, what does it mean by control? Well, every single dollar that we put into this whole life insurance policy, we're then able to borrow that money back out and use it for fun cash flow investing, go-karts, Disney trips, and the rest of it, okay? So we have complete control of our money immediately at all times. So just to kind of compare that to, let's say, a 401k. Well, if I put my money into a 401k and then I want to pull that money out to go buy a go-kart, what happens? Well, my money is gone out of the 401k, plus they penalize me, plus I'm going to pay taxes on that. With this, we can put it in here, pull it back out, and while it's in there, it's still growing for us. Okay, so we have all these protected. Life insurance is inherently a protected asset class by United States laws. Taxes, all the money that we put into the policy, it sits in that policy and compounds and grows tax-free for the rest of our lives. Legacy, what is the piece of this that we don't talk a lot about? That life insurance is built specifically for the death benefits. So we can create these policies. And Shawnee, I know you're reading What Would the Rockefellers Do Right Now again, and they talk a lot about this. So how to structure your banking system to give you all the benefits of today, but also creating a legacy and building something for your family for the future. So you can start to really integrate all of this stuff together. And the reason why I wanted to start with this is because what in the world, and the one thing we didn't even put on here, it's probably more important than everything, is guaranteed growth. So I want to write guaranteed, okay? So the reason I wanted to start with this is because when it comes to life insurance, not all life insurance is built equal, okay? So first off, why life insurance? Well, because there's no other vehicle in the United States of America, and these somewhat work in Canada also. They don't work anywhere else around the world. Only the United States of America has the laws that allow us to use life insurance the way that we do for the infinite banking concept. So that's why we use life insurance first and foremost. All of us went out and got life insurance licenses after we were practicing infinite banking and realized that we wanted to do it and wanted to share it and promote it to others. None of us had life insurance licenses prior. Now, I was a financial advisor, Series 766 and 4215 life insurance license. That was 15 years ago. I gave those licenses up 15 years ago. I re-got my life insurance license in 2020 when I learned about this stuff. Craig, when did you get your life insurance license?
It was 3 years ago.
Okay, 3 years ago. How long have you been doing infinite banking?
15. And, through my journey, I mean, I was just telling people about it and sending them to the people that helped me get started. And so I knew at one point I wanted to retire from my career and just do this. And this is my retirement gig. So I've had my license maybe 3 years.
I love it. So types of life insurance. So, okay, this is why we use life insurance. However, not all life insurance is created equal also. So number one, different types of life insurance. There's term. So we just talked about term. Term life insurance is you decide on a certain amount of time, a length, typically 10, 20, 30 years. You pick out a specific amount of life insurance. So like 20 years, $2 million policy. And then whatever, for me, a 42-year-old guy, 20 years, $2 million of coverage, whatever that costs me, that's what it costs me. Now, if I die during that 20-year span, then the $2 million gets paid out to my beneficiaries. If I live beyond 20 years, then I just basically gave the insurance company all my money for the last 20 years. Nothing happens. So the term is you buy it, it's used for death benefit, a specific amount of time, a specific amount, and then it's gone. Plain and simple, okay? So we can't obviously use this for what I just talked about with infinite banking. Number two, you have something that's real big right now on social media called IULs, Index Universal Life, okay? So Index Universal Life is basically a byproduct of what used to be called VULs or even ULs, which was variable universal life. Now, if we think back to like the '08 recession, VULs prior to that were pretty big. All the VULs collapsed at that time. Why? Because the market went down. Just like IULs, they're tied directly to the markets. When the market goes down, the costs continue to go up, the costs continue to be there, and people couldn't afford it because there was no growth within the policy to support the increased cost. And so all those things exploded. So the industry came out now with what are called index universal life, which are a little more restrictive than what the old VULs used to be. However, these are still directly tied to the markets, still have increasing costs, still, do not give you benefits immediately in most cases, high commissions to the insurance agents and everything else. So we have tried every way to split, what do they call it? Split the apple. We've tried everything to make IU work with the infinite banking concept. Over time, it doesn't. It's impossible. We've yet to be proven wrong on this. And so there's no way we should use these. Also, remember, the reason why we want to become the bank is for control, for stability, to be conservative, to warehouse our wealth in a protective, safe, guaranteed environment. This is where people get thrown off with IULs. They hear guarantee, well, I can never lose money in my IUL. Why? Because even if the market loses 10% in a year, I have a 0% floor, meaning I can't lose money. If the market goes down 10%, I don't go below zero. I can't go down -10. But what they forget is the IULs is the increasing cost. Just because your policy is not losing money, you still have to pay for the policy itself, which gets very expensive with IULs. So even with a zero floor, you can still really have these things blow up, and that's what we see happen all the time. And over time, because of the increasing cost, it typically does not keep up. And so there's a lot of like little things you can make. I always used to say this, and I'll say it to the day I die. With these IULs, as a salesperson, I can sell the shit out of IULs. Why? Because you can make them look beautiful. You can really persuade and really show people things and kind of hide the downside of all. You can make it look pretty. In reality, I would never own one ever because they just don't make sense. So why would I ever want to sell something that I personally would never believe in or do? I wouldn't, and so I never would. But so then we look at, and I'm just talking basics. I mean, these are basic policies. Of course, there's like asset protection, different things like that, different types of annuities that use life insurance, but your main products for life insurance. And then number 3, good old fashioned whole life insurance. And whole life is what we always use 100% of the time for IBC. Why? Again, because it's guaranteed, it's safe, it's protected. It's always going to grow. It has the lowest cost of insurance. It has stable cost of insurance. So what my cost of insurance is today, if I got a new policy today, when I'm 85 years old, it's going to be the exact same cost. So over time, it becomes a lot more efficient because of all that stuff. All right. So this is what we want: safety, stability, conservative. This is where we want to warehouse our wealth. And then again, we can layer in some term into this thing to keep it from necking, and we can do some things with it. But at the end of the day, this is what we use. Okay, does that make sense, Craig? Anything you want to add on that real quick?
No, I think it's really good to kind of list out the different varieties out there because there's a lot of confusion in the marketplace. And whole life is what we use. It's a boring product, but it works really, really well. And we do have, I've seen some questions flying through, and sometimes people say, well, can I use this for infinite banking? Can I use this for infinite banking? Could you use a line of credit? Could you use a HELOC? Could you use a savings account? You can. It's just that there are benefits that the whole life policy provides us that these other things don't. And that's why we use it. It's not because we love life insurance so much. It's just it's the best tool for the job.
Yeah, and we'll come right back to that too, Craig, and
Yep.
remind me, but real fast, just to continue on this real quick. So we determined, let's just buy in right now that whole life is the vehicle you want to use. Now we have to ask ourselves, is the life insurance company that we go with important? And is the agent that we go with important? Okay, so let's talk through that real fast. So what do I mean by the life insurance company? Well, there's tons of life insurance companies out there. There's Penn Mutual, Guardian, Mass Mutual, New York Life, Foresters. There's all these life insurance companies. One America, Lafayette Life. I mean, I could go on, Gerber Life. Like we could go on and on and on and on for days with all these different life insurance companies. Does it make a difference for the infinite banking concept? Yes, 100%. Okay, because what we want to deal with a life insurance company is what's called mutually owned. And the reason we want a mutually owned policy is because all that money that I keep saying goes into this policy that we can borrow back out that's guaranteed to grow. The reason why you have that growth within the policy is because it is a mutually owned insurance company. The reason why it's safe and conservative and protected is because it's a mutually owned life insurance company. These mutually owned life insurance companies are very, very regulated, and they're very conservative. If you go back 200 years and look at mutually owned life insurance companies, if you look at recessions, depressions, downturns in markets, these life insurance companies continuously always grow and always are strong, even in economic downturns, because of the way that they invest, because of the way that they operate, and because of the way that they're regulated. And so we want to have a mutually owned company. And what that means is when I buy one of these life insurance whole life policies, I become a mutual owner of that company. And what that means is each year when that company makes money, guess what they do? They give that profit to the owners of the company. Well, as a policyholder, I'm now an owner of this mutually owned life insurance company. So I receive an annual dividend back to me that goes into my policy and guarantees it to constantly grow. Now, the dividends are not guaranteed, but the companies we use, again, it's important to know what company you're working with, have paid these out for 120, 150, 180 years consecutively without ever missing a year. So it is important.
Wait,
I also want to look at like non-direct recognition and direct recognition. I'm not going to get into the weeds with this stuff, but this is important, and this is what we do every day. Go ahead, Craig.
are you telling me that these mutually owned companies were paying dividends during the Great Depression?
I'm telling
What about the bank holiday in 1933 when there was a run on the banks and they were shutting banks down? You're telling me these companies are still paying dividends?
100%.
Wow.
There you go. Yep.
I need some more of these.
Yeah, I mean, exactly. So you can see why the
Yeah.
wealthy do this. You can see why banks themselves do this. They constantly buying these whole life insurance policies because of all these different reasons. Okay. So we can talk to you on a strategy call. Again, Shauna will put the link over here. Schedule a call. All of our mentors that are going to be taking your calls are personally trained by Chris, by myself, by Brent Kessler, Money Multiplier. They're all Nelson Nash, infinite banking practitioner, certified trainers. And they all have policies, multiple policies they use in their lives every single day. So we have the experience. Remember, this is all we do all day, every day, full time. So the company is important. So we want to make sure we're using the right companies. Again, we can share with you the handful or so, half a dozen companies that we constantly are looking at. So Craig, if I do a call with you, what am I going to do? I'm going to ask you about why do you want this policy? What kind of problem are you trying to solve? What do you want to do with this thing? What are your goals in life? What are you looking to accomplish? And then we're going to say, okay, well, what does your financial situation today look like? And then we're going to take all that, we're going to build, and we're going to look at the various companies that we work with, and we're going to pick the company that best fits your needs. So some of you guys might get policies with One America. Some of you might get Lafayette Life. Some of you might get Securities Mutual Life. Some of you might have Mass or Guardian or whatever. But this is why we do what we do, okay? We always want to get what's right for the client. And then from there, the life insurance agent. Is that important?
Absolutely. And I guess as others are out there learning more about this, and if you talk to, I don't care if it's someone on our team or another group, if they're saying they can help you with infinite banking, the one really important question you need to ask them is, how are you using infinite banking in your life? And if they can't answer that question, you probably know they're not the ones that are going to help you. And just like Steven mentioned, everybody in our team is a user of this. We've been doing it. We didn't start out being life insurance people and then go do this. We were doing infinite banking and then we became life insurance people. So it does make a big difference over who you're working with and have they been using it.
I have a
And
question too, Craig, is
yeah,
if you have an IUL, like let's say you were to buy from that MPI person, not to give that much energy to that, but how quick can you actually use that policy? Like when was that first day you think that you can actually use it for something?
it's going to be a while because what you're going to look at is there's cash value accumulation, but then there's also what they call the surrender cash value, and that's what you can use. And so sometimes it could be a year, it could be 2 years before you get anything substantial out of it.
Yes. So to that point, if someone's selling you something and you aren't able to use it for 2 years, and you don't get a chance to be a Karen or to say, hey, this isn't working how you told me to do it, and you had that conversation 2 years ago with that guy, or you can have that conversation with us and you can use it within 30 to, let's say, 60 days. Just think logically about that too. The true salesman.
Yeah, and it's interesting because I'll have strategy calls and people will will have this perception because they've been told by others in the industry, you can't put money into a whole life policy and get it out within 30 days. It takes 1 to 2, 3 years before you see that. And yes, on a traditionally designed policy, but that's where it comes down to what Steven's talking about. If you're working with the right people that know how to do it, then that's a different picture. So
yeah. All right. All right. So let's talk about this whole life policy now for just a moment, because we keep using these terms, cash value and things like that. So basically, the way this whole life policy works is we have what's called a premium. So Craig, how can the premium, so how is the premium determined and how is the premium paid?
So a lot of that's going to be, so the amount you can put in there is going to be based on your gross income. And so that'll be, something we can help you figure out. But you might be putting in 500 a month. You might be putting in 6,000 a year. You might be putting in 50,000 a year. I mean, I've just personally, I've worked with people who are putting in 300 a month, and I've worked with people that are putting in hundreds of thousands a year. So everybody's in a different place. And what that comes down to is we want to understand your specific situation. I saw a lot of people saying, "Hey, I've got some debt. How do I do this?" I know Shane, you've been sharing that you've used our system to get out of debt. So it's really those deposits those premiums and deposits are going to be dependent upon your cash flow, your ability to fund it, and what are we trying to do? And so that's where a strategy call comes in play.
Yeah, absolutely. So you decide how much you put into it. You determine that. We don't tell you. Remember, we're going to build this thing backwards. I said a minute ago, a term policy. I say, hey, I'm 42 years old. I'm a male. I'm a non-smoker. I'm healthy. I want $2 million of coverage for 20 years. This is what it costs. Okay, that's what I'm going to pay. When we build these banking policies, we do that backwards. We start with what makes sense for you to pay into this policy, and then we'll build the rest of it around that, okay? And remember, like Craig said, you can pay in monthly, quarterly, annually, or biannually. So you have the options, and that can change over time as well. We can even put in a larger amount upfront the first year as well to kind of jumpstart this thing. It's what we call a dump in. So we have a lot of flexibility. And let's just say a few years down the road from now, God forbid something happens financially, you lose a job, something like that, you can't make that premium. We have a lot of flexibility to lower that premium quite significantly. And as long as you get that minimum amount in, this policy will continue to grow and compound for you and be there for you. And then oftentimes you can even make up for it, okay? And one thing I just want everybody to be clear, these are the premiums that go into this policy, but as a banking policy, you're going to start to change your mindset and you want to start thinking this more of a deposit. It's not, oh, I have to pay this life insurance premium. Oh, it's I get to put more money into my banking system. I need to deposit more money into my banking system. And as you start to use infinite banking more and more in your life, that right there is going to start to click and it's going to make all the sense in the world. If you're still looking at it as a premium, come to more of these trainings, watch more education on the YouTube channel, read Nelson Nash, read Becoming Your Own Banker, and the rest of it, and start having that mindset shift. Okay, so all these premiums now, they now go into this policy, okay? So all this policy, so what makes up this policy? Well, first off, there is cost, okay? So the cost, so some of your premium does go towards cost. The big part of the cost is the death benefit, okay? So part of the whole life policy is the death benefit, which is what a lot of the cost goes to. And then there's a small amount of administration costs and things like that. Of course, it is a company, okay? But remember, any profits come back to you in the form of a dividend. Now, the majority of these premiums and deposits, the way that we build life insurance policies for banking, the majority of it goes into what's called cash value. And for our purposes, the cash value is the important part because the cash value, what can we do with the cash value, Craig?
So this is where it kind of breaks down to, let's say that you have debts. We can take loans to throw on top of those debts. If you are wanting to purchase a car, you can take a loan from your policy to purchase that car. If, like what Shauna was sharing, she's now getting into private lending because she built her policy up and capitalized over time. So now she's using it as a opportunity fund to go build more wealth. So we're leveraging that cash value and we're in control of that transaction. And I think that's the important thing is we are in control of when and how to pay that back, when to take it, what we're using it for. And so those are the key points I would say on that one.
Yeah, absolutely. So that cash value, we borrow it out of the policy. And then we can use that money to, like Craig said, debts, cars, investing, fun. But the bottom line is we have complete control over it at all times. Then as we use that money, what do we start to do, Craig? We start to flow it back in to the policy.
Yep.
And
So it's no different than, a lot of people struggle with let's just say buying a car. If I'm buying a car, how do most people do it? Well, they either take money out of their savings to go pay cash, or they borrow from the dealership or the bank and then pay monthly, loan back over time. So you're always ending up at zero. You're either saving, spending, or you're borrowing and getting back to zero. And what we're talking about is you create this compounding machine while you're leveraging to go buy your car, and then you pay your system back while the whole amount is, whole amount minus some expenses.
Let me clarify that, Craig, real fast, because this kind of goes back to what you were saying a minute ago that I said we'd come back to. So, people were asking in the comments, well, can I do this with a HELOC? Can I do this with a savings account? Can I do this with, whatever? Well, here's what the difference is, okay? If I have a savings account at a bank, okay? So I have a savings account right here, and I have money in this thing, and I take the money out of my savings account to go buy a car. What happens with the money in my savings account? It's gone. It goes to zero, okay? There's no money left in my savings account when I take it out to go buy a car. Sure, I have a car now, but my money's gone. What's the primary difference here? Well, my whole life policy, when I take the money out of my whole life policy to go buy a car, what happens with the money in my whole life policy? It's still there. It's still there. It never leaves. It stays in there. And what happens is we're not actually taking our money out of the policy to go buy the car. We're borrowing against our policy and using this as collateral. So the insurance company actually collateralizes our policy, which allows all of our money to stay in there. And remember, I've said this many times, that all the money we put into this thing, it compounds, it grows, tax-free, uninterrupted, guaranteed for the rest of our lives. Simultaneously, we're borrowing the money out, we're using it to pay off cars, things like that. Now, here's the kicker. Am I charged interest when I borrow out the money? Yes, but here's the kicker. The growth, the compounding growth within this policy is going to outgrow the loan rate that I'm paying in simple interest on this loan. So it allows us to continue to grow wealth at a greater rate. And if you watch our, what we call our 90-minute infinite banking training video, we give examples on there on simple versus compounding interest. What it looks like when you're buying a car, using simple interest versus an amortized loan and things of that nature. So we give you these examples in the 90 minutes. So if you haven't seen that yet, go check it out to see exactly what I'm talking about. But this is how this works. So the money stays in here compounding, where with a savings account, with a HELOC, with any other type of loan, that does not occur. This is the only vehicle. Again, why we use life insurance and whole life is because of that right there. Does that make sense?
Yeah, we have a few questions if we can just clarify a few things. So a couple questions is that amount to start your policy? Can I overfund it? Can I add more? Can we just talk about your first policy, that amount, and how that kind of creates a ceiling essentially, and then the ways that you can, if you have some amount of money that you want to kind of dump in. Do you want to hit on that real quick about how you determine a policy, what you're essentially signing up for real quick, just with those amounts?
Sure. So at the end of the day, if you had, let's say you have $10,000 sitting in a savings account and you don't have another purpose for it, that could be what we call a dump in, where it's going to go in, it's going to be highly liquid. You'll typically have access to about 90% of that within the first 30 days. But now what we want to do is structure that ongoing premium, and that could be done annually or monthly or quarterly, semi-annual. And let's just say, for example, we designed the policy where you could put in a maximum of $1,000 a month into a policy. We can design a policy where you could put in a maximum of $5,000. It's just at some point we have to create that ceiling. And so let's say the 1,000 is the ceiling. Well, guess what? You can also do something less than that if you needed to. So if 1,000 was the ceiling, maybe your minimum would be 300 or 350. So when we're doing policy designs with you, we're going to want to understand what are those numbers that you can easily do, and what do we want to kind of like target on a monthly basis. And that goes into how we do the policy design. But at the end of the day, we need to know, what are you wanting to do with this? Because if, let's say Shauna came to me, she's like, hey, I've got $150,000 of debt I want to pay off in 2 years, and she's going to put in $200 a month. Well, it doesn't pencil out. The math won't work. Sorry, I'll say, sorry, Shauna, that's not going to work. if that's your goal, this is what we need to be able to put in. Like, well, I don't have that much. So we just need to really understand those goals and what's available and figure out how to put all of that together, because that's really, I would say, out of what our team does, that's our strength. We are laser focused on what are you trying to do with this policy. We're not just going to build you a policy to build a policy. We're going to build you a policy to help solve the problem that you're after. So does that help answer the question, Shauna, as far as the ceiling and the minimums? And
Yeah, I think so. And then we've kind of noticed that it seems like once you actually start implementing IBC, you end up building more wealth. And usually around like year 4, I know year 4 for me and Joe on our team just seems to be like that time when we're like, okay, it's time for a new policy. And then we kind of stack our banks up because we've maxed out that first one, and then we go to that next one.
yeah, and I think that point is also good with, I saw Jimmy asked something earlier about, as you
Yes.
add more policies to your banking system, do you ever feel overextended when premium time rolls around?
Yes.
And Jimmy brings up a really good point, because at some point you're going to think, well, let's say I'm 70 years old. How much do I want to have in premiums? Do I want to start a policy and be on the hook for premiums? And there's different ways we can design these. So we can use dividends to pay for premiums, especially if you have an older, mature policy. A lot of times it can just go on autopilot and pay for itself. So all of those things need to be considered, right? We don't want to just keep creating policies for the fact of creating policies. We want to have a purpose for it.
Yeah. For the new people and just kind of talking in terms that we know, it's almost like you're pledging an amount. You're saying, I'm committed to this amount for the rest of my life, essentially. And at some point when you're ready to do that, when you're ready to do another amount on top of that. And a lot of when you hear about this, you want one for yourself, you want one for everyone in your family, just like how Craig opened up today and saying, like, I want everybody to have one of these. And so sometimes a lot of people get started and they get a little overwhelmed. So you want to make sure that it's an amount that you can commit to so that you're setting yourself up for success in the long term.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
All right. So I know there's a lot of questions out there. Do we want to address some of those, or do we want to start jumping into some of the buy term invested difference? Because we did tell people.
Yeah, I mean, I think that's pretty much the basics. We can get some questions at the end, so keep the questions coming. I'll try and chat some into while Craig's getting into buy term and invest the difference. But I do feel like, yeah, now's a good time to get into it, Craig, because this is fascinating stuff.
Yeah. So, up to this point, what we really wanted to lay down is, what is infinite banking? Stephen did a good job just kind of talking about all of what this encompasses. There's a lot more to it, but now what I want to talk about, there's an opposition out there that says, why would you do what Stephen just talked about? It sounds like it's a scam, it's garbage, and you should just buy term invest the difference. So I just want to go through, and we're not offering investment advice. We're not investment advisors. This is just me and my journey. This is kind of what I came up with. This is the observations that I've made. And so I'm going to share out some slides and we'll just kind of go through this. And like I say, this is a pretty meaty topic and there's a lot of content here. So we're going to deliver you an opportunity to get this whole package, this white paper. It's like 53 pages of content if you want to read it. But we're going to give you kind of the quick view here. I'm going to be jumping around a little bit. And for those of you that have been with us for a long time, several months ago, we did kind of a full-blown buy term invested difference presentation. So I don't know if you guys had remembered some of that, but what I want to start off with is I want to pick on the mutual fund industry a little bit. And you can agree or disagree with me, but I'm just reading books, pulling out information, plus my experiences from the past. And so what I wanted to do is offer up a couple of resources. And one of the resources I want to talk about is a book called Guaranteed Income by Barry James Dyke. And he's got a foreword by the Honorable David Walker. And if you don't know who that is, he was the former U.S. Comptroller, almost like the CFO of the USA. And in this book, I read this book on a plane flight home from Florida. So it's not a long read, but it's packed full of really good information just about the mutual fund industry, the financial industry, and what they tell us to do versus what they do. So I think that would be an enlightening book for everyone to read. Barry is also the one that wrote the Pirates of Manhattan, if you want to learn more about kind of the back ends of, the inside of Wall Street. And then a couple of weeks ago, maybe 3 weeks ago, on one of the WTF shows, Brian Fouts, who's on our team, had Andy Tanner on the WTF show. And Andy Tanner was just talking about the 401ks. And I thought what he had to say was really, insightful. And I've read a lot of books, but I picked up his book on 401k. He calls it 401 Chaos. I would encourage you, whether you like or don't like 401ks, it's a really good book packed full of awesome information. So buy these, read them, study them, learn what's being said in there, and then you can decide if you want to make a change on that. But I wanted to share a couple things out of the book. So in Andy's book on page 72, and I'm just going to read this off because it just was very insightful. Think about from 1995 to 2008, the Fidelity Magellan Fund alone reaped $4.8 billion in fees for the company. Yet during that 13-year time frame, Fidelity Magellan grossly underperformed against the S&P 500. So one of Andy's points he's making is, why are we putting our money into these funds and paying all these fund managers all these fees, 4.8 billion in this case, but yet they continually underperform the S&P 500? So couldn't you just put your money in the S&P 500 index and do better? And then he goes on to talk about, in the first quarter of 2007, before the subprime crash, Standard & Poor's reported that the majority of actively managed mutual funds failed to beat their corresponding benchmarks. They found that over the previous 5 years, the S&P 500 had beaten 72.2% of large cap funds. S&P mid cap 400 had outperformed 77.4% of the mid cap funds, and the S&P small cap 600 had outpaced 77% of the small cap funds. So here again, we have billions of dollars in fees that were spent on poor investing performance from 2008, and so money is just flying off the shelves, right? I mean, their funds aren't performing very well, but they're getting paid a lot of money to take care of our funds. So then we go on to see, well, what does Barry have to say about this? And he's talking about how Morningstar, who's a major research firm, found that by December 19th, 2014, a whopping 89% of US stock mutual funds failed to beat their benchmarks. And so then he goes and he talks about these domestic funds. So in 2011, there were 703 actively managed mutual funds in the top 25%. In March 2012, there's only 216 remained. In March 2013, only 33 remained. In March 2014, only 2 remained. So my question is, and I just want to throw it out there, is, have you ever really sat down to think about why you put your money where you put your money? Because when I read this stuff, I'm thinking, well, these mutual fund managers are making a lot of money off of people, and it doesn't seem like they're delivering the goods. So I just wanted to share a couple of those resources. Don't take my word for it. Go read the experts. I mean, Barry Dyke is really sharp on this stuff. Andy Tanner's a really sharp guy. And, so read what they have to say and then do some of your own research. Stephen, anything to add on that? Because I know you kind of lived in this world many, many years ago.
You keep rolling. It's good stuff, and those are good resources for sure.
So why I want to kind of start with that is there's a Buy Term Invest the Difference white paper, which will get you the link to be able to download that at the end of the show. Why I want to talk about the mutual funds is because in the study that we built on the Buy Term Invest the Difference, I used all S&P 500 historical returns. And some people say, well, why didn't you use Dave Ramsey's magical mutual fund that gets 12% every year? He has videos talking about how he has gotten 12% every year in his mutual funds. And he must be the only one, because it must be a magical mutual fund out there. I don't know of any mutual funds that have done that over 20, 30 years. So when you look at the performance of the mutual funds, we already can see evidence that just putting money into an S&P 500 index is oftentimes better. So in order to make this a fair kind of analysis, what if we used the best periods of the S&P 500 to do an analysis of Buy Term Invest the Difference It's just funding a policy and then using the cash value for investing. So let me say that again, because this is critical to know. If I had $25,000 to put into something every year, what if I paid enough in term and I put enough of that 25,000 in to buy, say, $600,000 of term insurance, or I took that 25,000 and put it into a whole life that also gave me $600,000 of term insurance. And I'm just saying if we mapped it out that way. And then in the buy term invest the difference, we took the rest and put it into the S&P 500 index. And what if we take the cash value and put it into an S&P 500 index? What does it look like over time? That's the question that the study had. So who here, and I'm just going to throw the question out and you can read it in the document. We're not going to go through all the details today, but if I were to buy term invest the difference and put my money in the S&P 500, who thinks that long term would be a better performer than if I were to take the same amount of money, put it into whole life, take the cash value and put it into the S&P 500? Which one do you think would win? Do you think the buy term invest the difference is the winner, or do you think the whole life plan is the winner? Anybody want to take a venture to vote? So we have a hell no and a whole life. A whole life, whole life, whole life. And you might actually go, well, Craig's talking about this, so obviously the whole life must have won. And I didn't engineer this to make whole life look better. Matter of fact, I used a 60-40 policy, which is not the highest cash value performing policy we can possibly design. So anyway, with all of that said, there are some principles that I wanted to go over. And when you read this study, what we're talking about is there's really three stages of the financial journey, and I call it the accumulation stage, which is we're working, maybe we're putting money in a 401k, or we're putting our money in a whole life, but we're taking our active income and we're building assets, we're trying to build cash flow, we're in this accumulation phase. We don't really need it for retirement. At some point, there's a distribution stage of our life where maybe I don't want to be generating active income. I want my investments to pay for everything going forward. And so that's kind of the drawdown period. And then at some point, and the insurance companies have done a study where 1,000 people were born. Guess how many of those died eventually? 1,000. So eventually we're all going to get a legacy. And so those would be the three key stages of the financial journey. And so I'm just going to kind of jump around here a little bit. All right. So anyone here listen to Dave Ramsey talk about his 12% mutual fund? Have you guys ever heard him talking about that? If there's anyone that has, just put in the chat, I've heard it, or, oh yeah. So I've heard him say it too, and I just don't understand where he's doing this. But what he puts together is that he'll tell you he's in opposition of the 4% rule. And for those, I'm gonna go back one slide. For those of you that don't know about the 4% rule, back in 1994, there's an investor or a financial advisor that said, what is a safe withdrawal that I can take from my retirement account so I don't run out of money? And he did a bunch of number crunching and came up and said, well, I think 4% is the number. That's been tested and that's been talked about. And some people are saying, well, it should be closer to 2.8 or it should be closer to 3%. And it really depends on your stock and bond allocations and all these different things. But even if 4% was the number, which a lot of people say it isn't anymore, if you had $1 million 401k and you did a 4% drawdown on that every year, you now have a $40,000 taxable amount of money that you have to live on for the rest of your life. Well, plus Social Security if that's around. But so those numbers get pretty small. So Dave Ramsey's calling BS on this, and he's saying, oh, no. If you have a 12% mutual fund, you can safely take 8% out because you still have 4% in there growing. So my question is that truth or is that fiction? Who thinks if you had a 12% magical mutual fund, would you be able to take 8% out every year and never run out of money? Felix knows it's fiction. Christian knows it's fiction. All right. So I ran the numbers, and to be fair, I went back to 1970 because around 1970 and actually 1975, the following 30 years were some of the best runs of the S&P 500. But from 1970 to 1999, the S&P 500 averaged 10.85%. So I thought, well, let's see how the numbers work out. What if I were to take 8% of my million out every year? Would I run out of money? Well, I ran out of money in year 14 based on this model using historically accurate numbers from the S&P 500. If I had $1 million in 1970 and I took out 8% every year of my balance, I would run out of money in year 14. Now, I didn't consider taxes or fees in this model either. So one of the things you're going to see is when we have these downturns in the market, that really hurts my balance when I'm losing this much money and taking a planned withdrawal. We'll talk about what the drawdown effect and sequence of returns does to our investments. But to be fair, a lot of people came back and said, well, Craig, you're not really being fair on this because you should be taking 8% of the balance, not 8% of what you started with. I said, okay, well, I like that. I really appreciate people kind of highlighting that because I'm not perfect and I can't run every scenario. So then I went and did that, and I was able to take 8% out of the balance at the start of the year. But now our income based on the balances and the ups and downs of the market, some years I had 95,000 to live off of, and some years I had 39,000. So what I call this, in some years I'm eating prime rib dinners, and other years I'm eating ramen noodles. And maybe you like ramen noodles, I don't know, but that's kind of a wide range of income that we're really dealing with if we were to take the 8% based on the balance. And Rob Joseph likes beans and rice, and I actually like beans and rice, but it's one of those things where if you don't like beans and rice, that's probably not that fun to eat. I'm with you, Shane. I like steak as well. Who here has heard of an organization called Dalbar? Anyone know about Dalbar? All right. Well, Dalbar, they study, it's an organization. They do a bunch of different analysis, but one of the reports they do is called the Dalbar Quantitative Analysis of Investor Behavior. And what they're looking at is what are people really getting out of their investments, and what are the actual behaviors of investors. So Stephen, let me ask you a question, because you were in this industry a while back. What do people do when the market starts declining? What kind of behaviors do they have?
Emotional behaviors. They start to panic. They start to want to sell, and the rest of it.
And so would it be fair to say they panic and they buy high, sell low, all those types of things we're told not to do, and that's what they're doing?
Yes, exactly. I think there's even a term for it these days. I've been hearing going around, calling people panicans.
Panicans. I haven't heard that. But yeah, I mean, that's exactly what Dalbar is measuring. They're seeing this over many, many years. And in their report from 2021, it said that the average equity fund investor realized 6.24% over 30 years and 5.96 over 20 years. So when I hear people talking about, oh, I made 14 or I made 20% in my 401k, it just, the numbers don't make sense for me. Now, I know there's people, and there's probably people in this community on this webinar that know how to do the stock market, probably do very well. They know how to do calls and puts and can do some really fancy things. But for the majority of people, they're getting smoked. They're getting in trouble in the stock market. So for those of you out there that are the Warren Buffetts of the world, or really know how to play the market, this isn't necessarily talking about you. It's talking about the mass of people out there. Now, who here has heard of the drawdown effect?
Yeah.
Does anyone know about the drawdown effect? Shauna, you know about it, right? And it just simply talking about when there's a downturn in the market, let's say there's a 10% loss in the market. We don't need a 10% gain to get back to normal. We need an 11% gain to get back to where we started. And you can see a 20%, I need 25% gain. If I have a 30% loss, I need a 43% gain. If I have a 40% loss, I need a 67% gain. So you start to see, wouldn't it, you're going to have to gain a lot more every time we have those big losses. And James, I like the comment you just put in. Wouldn't it be nice to pause withdrawals in a down year? And that's exactly what we can do when we have a whole life policy, is we can say we're going to take the minimum withdraw from our retirement accounts, and then we're going to go tap into something like our whole life policy or our other investments. And we call those volatility buffer, covered assets, different types of strategies. But so Stephen, on your WTF this morning, you were kind of talking about NVIDIA and Apple and some of these other stocks. I mean, what do you think, so like NVIDIA, what do you think could happen to that stock in terms of if it goes to a resistance level? What do you think that loss would be?
Tremendous. I mean, Nvidia is sitting, where is it right now today? It's down big time. Sitting at 102, $102 per share. I mean, it was up at $142 a share just a couple months back, but you start looking at resistance lines. I mean, that thing you're probably looking at $40 a share where it could go to.
And so you look at the drawdown, and the point is just make it really simple. Is like, hey, if I lose 40% in my stock portfolio or my investment, I need 67 just to get back to where I started. And so there's some information here that I can share on, and just kind of mapping it out. If let's say you started with $100 and you lost 10%, that means we now have $90 in our balance. We have to get 11% gain to get almost back to the 100. That's what we mean by the drawdown. It's just simply when we have a drop, we have to get a certain amount of gain before we get back to zero. And it just shows based on the severity, if I drop 40%, I need to go up 67%. That's all this table is showing. And really just take away from this slide, this concept is when you have a negative in your account, we need much more to get back to positive. And then I ran the same numbers considering taxes and fees. So if we just consider a 1.5% investment fee and we consider a 21% effective tax rate, well, if we have a 40% drop in our investment portfolio, it's got to go up 91%. If we have a drop of 30, it's got to go up 61%. This is very detrimental to your retirement funds. This is detrimental to your portfolio. And so let me ask you a question, because what I'm showing here is a drop one year and a gain next year. How often does that happen where we have a major drop and then a gain right away? I mean, it doesn't happen, does it, Stephen?
No.
So here's a piece of trivia. How many years did it take for the market to recover after the Great Depression started? How long do you think it took for the market to recover after the Great Depression started? Go ahead and put in the chat. How many years do you think it was? So we have a 36, a 13, over 20,
70.
20 years. What did you say, Shauna?
70.
70. Let's see. It looks like so far, Chris. David comes in with 25. We got some 25ers. You guys must have looked at my slide down here, because indeed it was 25 years. So think about if you were one of those people that had, money in the market and you needed it for retirement at some point and you had to wait 25 years just to get back to zero. And so that's probably the case. But I also looked back in time and I said, well, what about Black Monday on October 19th, 1987? That was about 2 to 3 years. The 2008 global financial crisis, some people say it was 5 years, 6 years. But the point is, if we have a 30% drop or a 40% drop and we need to get up to 50 to 60%, that's not going to happen overnight. It could take you 6, 7, 8, 9, 10 years. All right. So just be aware that exists. And I went through and mapped out from 1975 to 2004, the S&P 500 averaged 11.16. But what happened in reality, if I started with $100 at year one, in 1975, well, it went up 31%. I'm pretty darn happy. And then it went up 19%. I'm pretty happy. And then it dropped 11%. So essentially what I wanted to see, what happens when we have these consecutive downs where it's 10% down, 13% down, 23% down. If I started at year 25 with $2,143, which you see over here, how long did it take me to get back to 2143? Well, it didn't happen for the next 10 years. I don't see 21, anything higher than 2143. It almost did it right there, and then it dropped back down. That, my friends, is the impact of downturns in the market. And what we don't know is how long will it take to recover. So that was the only point I wanted to make there. The fees. And if you go to the sec.gov investor site, it's kind of interesting because they'll tell you that fees have an actual very large impact to your portfolio. So this box that I highlighted says, in 20 years, the total amount paid for a 1% annual fee. A 1% annual fee adds up almost to $28,000 for a $100,000 initial investment. That's a lot of money. And in addition, if you were able to invest that $28,000, you would have earned an additional $12,000. So when people talk about, oh, my portfolio or my 401k only has a 1% fee. It's huge. Over time, it's huge. So we don't want to minimize those. So this next section kind of goes into fees. I'm not going to go into all of that right now. But what I wanted to share with everybody, when you get the full document, there's going to be some different use cases. And what I mean by that is we're going to compare funding a whole life policy versus funding a savings account that earns 1%, 3%, or 4.5%, and just compare it. And so you'll see in the document views like this. It's a lot of numbers, but the point is at some point in the future, maybe the savings account is ahead, and you'll see here at end year 5, the whole life policy has, a cash value number of 113, whereas the 1% savings account's 122, 128, and 132. But by year 8, the policy passes up the savings account, the 1% savings account by year 11, by year 18. Now, the other thing that I'm not doing, to be fair, is I didn't really consider taxes inside of this, because this is growing tax-free. This is taxable. So those numbers will change as well. But what I want to look at is what happens when we get to distribution. And let's say that we are going to take a $55,000 income from each of the plans. So from our whole life policy, we're going to take $55,000 of income for retirement. Even at age 95, we still have about $900,000 of cash value and a death benefit of 1 million. At age 95, if we use the 1% savings account, we're out of money. We're actually out of money at age 80. If we use the 3% savings account, we're out of money at 90. If we use the 4.5% savings account, we don't run out of money, but we're pretty much depleted at age 100. So even looking at a savings account, the policy will still outperform that over time. So you can look at that. And then we get into some other use cases where we're taking the S&P 500 and some of the best years of the S&P 500, 1975 to 2009 was a really good, 30-year run, and start looking at what would it look like if I bought a term policy and then put the rest of it into the S&P 500. What would it look like if I funded a whole life policy and put the rest of it into a whole life policy? And so we just kind of run the money through, and we can see that about year 20 is where both of those, where we kind of equalize, where the whole life policy has a little bit more than the buy term invest the difference strategy. But up to that point, the buy term invest the difference might have been a little bit ahead. But what I like to do is say, well, if we consider taxes, what would be the equivalent? What is the equivalent tax-free value of 111? So if my policy has 111,000 in it, and I had a taxable account, how much do I need in there to be equivalent? So I would need my S&P balance to be 140, because that's taxable, to be comparable to my 111 that's not taxable. So really, are we waiting 20 years to be equal, or are we waiting 5 years to be equal? So it's one of those things where it just, when you start considering taxes and fees, the picture really changes. So anyway, I just want to go through and show you that there's different use cases where you can now say, well, what if we use the policy versus buy term invested difference with a 60% stock, 40% bond mix, and who wins? Well, the policy does. What if we took the S&P 500 and we backed out, maybe 5 to 7 years before retirement, we started doing some conservative type returns? Who wins? And so in all these models, and you'll see in the white paper, all of these models, the policy wins in every one of these races. And so that's really what the study is about. And what I wanted to just kind of focus on today was just start thinking about where you're putting your money and why are you putting it there? And is it the best strategy? And what we did with this use case study is we really wanted to show as much as we could apples to apples, where we're putting money from the cash value into the market, or we're taking money from the buy term invest the difference and putting it in the market. But Shauna, let me ask you a question with your cash value, because you mentioned it, that initially you were doing vacations and now you're doing private lending. How does your private lending compare with Dave Ramsey's 12% mutual fund?
It outperforms it for sure, because I'm making money twice and I'm making a lot more than 12%.
And so what the point there is that there are options to do other things outside of being in the market. Isn't that a fair assumption?
Yes.
Yeah. So I know we covered a lot of material, and I just want to go back to some of the Q&A. Do we have any questions that you've seen that we need to address live, or something we can address live?
I think I'll just go to the Q&A first and we'll start here.
Okay.
George is saying, can I have my niece insured with me paying the premiums and money deposits and myself have the ability to take out the loans to use for IBC?
Yes. So George, we would have to put a case together for why you're wanting to get a policy on your niece, but we've done that in the past. We have clients that have put policies on nieces and nephews. And the way it would work is her body would be the one insured. You would be the owner and the payer of the policy. So you could use the cash value. And when you graduate, you pass on, you could gift that policy over to her so she could become the owner at that point. So yes, you could do that. And then questions about, are we getting these slides? Are we getting these recordings? So Yvette, as far as the slides, we're going to share a link where you can download the Buy Term Invest the Difference document. And it has all of those case studies I just put in there. It's just too much to go over in an hour and a half webinar. So if you're interested in digging into the math and the materials behind it, we're going to give you that white paper. It took me about 7 months to put that all together, and we're just going to give it to you. So happy reading. And then as far as the recordings, all of the recordings go up on Chris Naugle's YouTube channel under the Wealth Webinar playlist.
Yes. So on Chris Naugle YouTube, which we also do in about 2 hours from now, we do a live stream there, and it's about an hour of just rapid fire, just Q&A only. So there's a lot of questions today in the chat, which is great. That's another place for you to go to for question and answer. But there's these things called playlists on YouTube, and there's one specifically for the Wealth Wednesday webinar replay. And so
like a bookmark, but YouTube.
Yeah, so today's recording will be up on Saturday. So when you see a live, it's about 3 or 4 days later, it'll wind up on YouTube.
And I'm going to put in the chat the link to get the white paper.
And then Lori's just saying, I'm not understanding why the comparison with the S&P 500.
Yeah, I mean, that's a good question. So when we think about the strategy of Buy Term Invest the Difference, that really stems from, it stems from a conversation where don't buy a whole life policy, buy a term policy to cover your death benefit, and then put the rest into your market, your stock funds, your index funds, your mutual funds. So that's traditionally been the narrative. So why we picked the S&P 500 is, one, I felt that because of the mutual funds and the variability of their performance, most of them don't even outperform the S&P 500. Is that why don't we use the S&P 500 to buy a term policy, then put the rest of our money that we would have put in a whole life into the market? And then to be fair, we're taking the same amount of money and buying a whole life policy and taking the cash value out of the whole life policy and putting it into the exact same S&P 500 funds. So we're trying to keep it apples for apples. But so Lori, to your point, could we have done this with buy a term policy and do private lending? Absolutely. But a lot of the folks that are pushing Buy Term Invest the Difference are stock market, Wall Street kind of folks. So I wanted to kind of keep it into that realm.
All right, cool. So bonus, we got 5 extra minutes. You guys want to stay around 5 more minutes? I'll do a little bonus Dexter asked for. So one of the things that clicked with him when he first learned this was showing the example of how you buy cars and what that looks like. So I just want to do this real fast for everybody because it is a cool little quick example of how kind of simple interest and different types of loans work. So we have a real simple question to ask of you. Can you make money earning 4% while paying 6%? What do you guys think? Can you make money earning 4% while paying 6%? What do you guys think?
Oh, we have some yeses. I think some of these people have seen this already. So they're
the ones that have been around are sticking with us. Well, if you're new, check this out. All right. So the best way to explain this is, let's say you go to buy a car. It's worth $25,000. I have $25,000 sitting in a bank account. All right. So I go to my bank and I say, hey, I'd like to go buy a car for $25,000. So I need to withdraw $25,000 from my bank account. And then the banker comes over and they say to you, well, listen, hey, I know you want to go buy a car for $25,000. However, we'll make you an offer. instead of, just giving you your $25,000 and that money's gone, what we can do is we can actually give you a loan to go buy that car for $25,000. That will allow your money to sit in your bank account growing at 4% for you. And then you can go buy the car. And you say, okay, well, that sounds cool. I get to keep my money in my account growing for me. I can still go buy the car, get the loan. Well, what are you going to charge me for the loan? That's the next question, right? Like, how much interest am I going to pay on this loan? And the banker looks at you and goes, the loan is going to be 6%. And you look at that banker and you say to them, oh, wait a minute here. So you're going to give me 4% on my money, but then I'm going to pay you 6% on your money. I don't think so, Mr. Banker. I know you have a whole basket full of lollipops sitting here, and the name on those lollipops is Dum Dums. I know you think we're all dummies, but no, I'm not going to pay you 6% while you're giving me 4%. Just give me my money. And the banker says, no, you don't understand. So then so let me show you what this math looks like. Because when you take a loan on, like, let's say a vehicle, right? Let's say it's a 60-month loan, 5 years, very common for an auto loan. Well, what happens each month that you make a payment? Well, you're going to pay that thing, in this case, $483 a month. Well, what happens with that $25,000 balance as you pay those monthly payments? Well, that amount lowers, okay? So what we're doing is each year, we're paying 6% on a lower and lower balance. So at the end of the day, at the end of the 5 years, the total, that $25,000 becomes just under $29,000 at 6% annual interest. But what's going on over in the bank account? Well, the bank account is doing what? Is that $25,000 balance increasing or decreasing each year? It's increasing, right? Because you're making 4% off 25,000. Then the next year you're making 4% off, let's say 26,000. Then the next year you're making 4%, which equals maybe 27,500. So each year is higher. Well, on the auto loan side, the balance each year is lower. So when we look at it at the end of 5 years, the car loan paying 6%, the bank grew that to $29,000. Well, sitting over in our bank account at 4% growing, our money grew to be $30,525. So if we would have listened to the banker in that scenario and we would have earned 4% while continuing to pay 6% during those 5 years, we actually would be ahead by $1,526 by doing so. And so when you look at the infinite banking concept, this is essentially what we're doing. We're putting our money into these policies, our money sitting there and compounding and growing. The balance is always getting bigger and bigger. It's compounding. That's what compounding. And Albert Einstein said this best. Albert Einstein said, compounding interest is the 8th wonder of the world. Those who understand it use it, those who don't pay it. And so we want to be the ones that are using compound interest to our advantage. And that's exactly what this quick example shows. Remember when I was drawing this stuff on the board before, I said, we'll come back because when you borrow the money from your policy, you do pay interest to the insurance company on that money. But that's that caveat right there. Our money in our policy is growing and compounding. At the same time, we're paying a simple interest on a depreciating loan each month and each year. So the math becomes amazing. And that's where you guys can either take my word for this, or you can connect with our money mentors. Our money mentors will use the tools that Craig created called our BYOB Vault tools, and they can show you mathematically exactly what this does for your personal situation. So it's really and once you see this stuff, you're never going to be able to go around to the other way. So thanks for bringing that up, Dex. That is a real simple, great example right there to understand how all this works. Does that make sense for everybody?
Absolutely. Thanks for going through that. And one just housekeeping thing. It sounds like John was having some troubles getting the white paper. I'm wondering if anyone else. So Shauna, you just checked it?
I actually just checked it, so I can just share my screen real quick and I'll show you what happened. So I filled it in, and then this was that second page after I put in my name, email, phone number, and then there's this green button that says access books and resources now. And then it did open a new tab.
And then you want to click on that download button.
And then download right there, and then I'd be able to download it to my computer.
Yep. Okay. Yeah, and I can put the link back in there real quick. Sounds like some people missed it. And then if you want to connect with our team, Stephen, do you have the links ready, or Shauna, that you can just send that in? And
yeah, definitely. Just schedule a call with our mentors, and like I said, they can talk to you about what's right for you, what the situation is, and show it to you using the tools. It's amazing stuff.
Yeah, and if anybody has any troubles, and I see that Rob's asking how to reach me. If anybody has questions or comments on the white paper or have questions specifically for me, I'm going to put my email in the chat and you can just contact me here. So if for some reason you can't get the white paper to work, let me know. And then also, if you have questions about it, happy to address those as well.
All right. All right, cool. Any last words, Shauna, Craig?
Yeah, last couple words. We have an event coming up, right, in Dallas soon. So let's talk a little bit about that, see if anyone's interested in coming out to meet us and see us.
Yeah, I'd love to invite everybody. We have an event in Dallas, Texas, May 8th and 9th. It's the Private Money Club Money Tank. We've done these now for a few years, a couple times a year, and they're really always probably one of the best events that we put on. And quite frankly, the students and people that attend, they tell us they make more connections and relationships than any other events they attend. And I think a big reason for that is Private Money Club is built along a community of like-minded individuals that are looking to succeed, looking for something a little bit different, looking to make relationships and connect. And that's what Private Money Club is. It's people that are needing money for real estate opportunities, real estate deals, and people that are controlling their money through infinite banking and self-directed investing and everything we teach here at BYOB Money School. And we're bringing those two people together to make magic happen. And so everyone comes to this event with the same ideas, the same attitude, the same thing in mind. And it's just amazing what goes on there. So we have a full lineup for 2 days. We have dinners planned, we have drinks planned, we have 30 some experts and people coming, part of our team. We'll have over 100 different students and clients and members there. So it's an amazing event. So get there. We have maybe 3 VIP tickets left, Shauna, I believe, and maybe a dozen or so general admission tickets. So get a ticket today, figure out the travel later. It's privatemoneyclub.com/money tank. And basically just click on the site. You see all the details, May 8th and 9th. Once you register, we'll email you with the hotel location and how to book all that good stuff. But yeah, man, it's going to be an awesome event. Really looking forward to it. So get your tickets and we hope to see you there. Craig will be there. Sean will be there. And like I said, a whole bunch of people from our team will be there. It's going to be a cool event.
Yeah, and honestly, traveling, the hotel is super affordable nightly rates, and I feel like for the first time in years, flights were not so bad. So I don't know what's happening. So it seems like the perfect storm to get there. So make it.
I agree.
Hey,
when I went
Andrew,
to
it's
book
always
my
funny.
flight.
Oh, sorry, Craig, go ahead.
Oh, go ahead.
Well, I was just saying, Andrew said, first time to Wealth webinar, I didn't realize they were this long, in depth, and thorough. Thank you, everybody. Yes, like every week we do this, Andrew. So it's always new, always something different. It's either myself, Craig, usually Chris is on. We have Brian Fouts occasionally, who's a stud mentor of ours, and we're always figuring out, strategizing new content, new training. You know, if you guys ever have ideas for us as well, I mean, we're always open to, you know, teaching what you want to hear. So don't, you know, feel free to reach out to us, email us, text us, and let us know what you're looking for, and we'll create a training based around that. But yeah, we're here every single Wednesday. We started these in 2020, and we never miss a Wednesday, no matter what. So thank you for being here.
Yeah, and I'll just throw out too, if you want to engage deeper in the community, we've got the Infinite Banking Facebook group. We've got Chris Naugle's YouTube channel. Go out and subscribe. You'll hear every time we're going live with events. And then if you are on Facebook, you know, reach out to Steven, reach out to me, you know, become friends. Sean, you know, friend us, and we're all about building this community up and engaging with you to help answer questions and help you along your journey. So let's be friends.
Awesome. Good stuff. Let's wrap this baby up. Thanks everybody for being here. Shauna, Craig, like always. Craig, amazing job with the buy term and invest the difference killer. I don't know, what do we call it? It's a white paper, but it's a hey, let's change our mindset, or let's change our framing around things, right? Cool. So thanks for everybody for being here. We'll see you guys at 4:30 Eastern for Ask Me Anything. See that on YouTube and social media, and we'll be right back here next week for another wealth webinar. Thanks, y'all.
Thank you all.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.